You might know Cathy for predicting back in 2018 that Tesla would hit $4,000 a share. She hung on amid a torrent of scorn on social media. Now that, and many of her other bets on disruptive innovation, are paying off massively. Cathy's biggest ETF has returned well in excess of 100%, and Ark's assets have swelled to $50 billion.
We still think there's a lot of room or runway ahead because what we think is not well understood is exponential growth.
Ark's research suggests that the global economy has entered a period of convulsive changes. Some exceptionally good and others devastating, that will shape financial markets for years to come. Thanks to seeds planted during the tech and telecom bubble more than 20 years ago, record-breaking technological changes are creating not only exponential growth opportunities but also black holes in global economies and financial markets. Staying on the right side of change will determine success and failure not only in investment portfolios but also in careers, companies, and countries.
Tesla is one of the most maligned stocks in the stock market, and I'm one of the most trolled portfolio managers on Twitter in the world because of Tesla. But our conviction here is it is our highest conviction stock. It is the largest position in our portfolios. We think the autonomous taxi opportunity is going to be even bigger. So if we knew today who was going to win in the autonomous taxi network market, given the cash flow models we've done out to 2030, these are software as a service or transportation as a service models, very high margin models, we would be willing to pay $2 trillion today for those companies in the marketplace. Our geneticists, and you're going to have one, so am I, are going to be able to identify for the first time the needle in the haystack. They're going to be able to identify which genes in our genomes have mutated. In other words, they've developed a programming error. And now with CRISPR gene editing, following it up, we're going to be able to correct those programming errors. It's going to be incredible to catch cancer in stage 1 and then edit it away. We think that's going to be possible in the next 5 to 10 years, and probably sooner than that. So that's real impact.
Joseph Carlson is one of my favorite YouTubers. He has a channel where he talks about his dividend portfolio. For more than 1 year, he has been sharing with us his strategies, his knowledge, and most important of all, his soberness about the stock market. And Joseph has a different perspective about Ark Invest and Cathy Wood that I would love to share with you.
Well, Cathy, thank you for joining us. You're a little bit unusual in that right now you've got under management, so to speak, a mere $45 million.
For those of you who don't recognize her, her name's Cathy Wood. And like Steve Forbes pointed out during this interview in 2015, at the time she was only managing $45 million, which is a small amount for a fund manager to be managing. But things were soon going to change for Cathy Wood. In a few short years, she went from being unknown and managing a small amount of money to becoming one of the most well-known fund managers in the world. She founded Ark Invest, her investment firm that she describes as solely focused on disruptive innovation. And she's been very consistent. That was her same focus when she first started.
So indexes are where they are because of what has happened historically. So over the last 30 years, we've had some very big companies grow up, evolve, and grow into the biggest companies in these indexes. The world we're going into is much different, we think, than the world that we've just left. And that's because, and this gets into disruptive innovation and why we formed Ark.
Disruptive innovation. That is the purpose for Ark Invest. Cathy Wood created it to give you an opportunity to invest in these disruptive companies. She believes that we've left this old world and that we're entering into this new world that's going to be ran by newer, innovative, disruptive companies. And she believes that investors that don't focus on these new companies, well, they're going to be left out. And all of this popularity and notoriety has attracted a lot of new investors to ARK funds over the past year. The amount of inflows into these funds has increased dramatically. The trading volume is huge. It's beating out companies like Netflix and Disney. Investors are piling into Ark Invest funds as fast as they can. They're throwing as much money into it as fast as they can, and this has grown her assets under management significantly. She's no longer managing $45 million. Now in just one of her funds, her flagship fund, she's managing $8.9 billion. So what do we make of Cathy Wood? Is she really the new stock picker of our day? Is she really the new Peter Lynch of our time? Is she going to have these great annualized returns for the next 12 years? And especially if we're an ARK investor, we're investing in her funds, what should we be the most concerned about? We're going to discuss all of that in this episode. Let's first start off with one of the boldest predictions that Cathy Wood made that she put her entire reputation on. She went publicly on networks like CNBC and said that Tesla was going to get to $4,000 a share. This was back in 2018, when Tesla was currently trading at $60 a share, and she defended her prediction over and over again. Cathy Wood has been proven correct prediction after prediction. So the question is, if Cathy Wood has such good predictions, if she's been correct so many times, and her funds are performing so well, why don't we just invest in it? Why doesn't everybody invest in Ark Invest? That seems to be where all the money's being made. And that seems to be what most people are trying to do now. Just last month, December 11th, Cathy Wood takes the crown from JP Morgan for the largest active ETF. Now Ark Invest has a bigger active ETF than JP Morgan. JP Morgan manages over $3 trillion. This is an incredible feat. Investors are piling into Cathy Wood's Ark Invest, and that's where I want to give a warning. There's an article written by Ben Carlson, no relation there, but he says a short history of chasing the best performing funds. This is where he outlines what's happened in the past of different people piling into the best performing funds. The first thing that we can look at is the assets under management of Ark Invest. Look at this in just 2020. It went from what? $1 billion, $2 billion to $18 billion. That is an incredibly rapid growth. The mainstay market field fund was a huge beneficiary of this investor demand after losing just 13% in 2008, a year in which the S&P 500 lost close to 38%, and when the fund beat the S&P 500 by 9% during the 2009 snapback rally, investors piled in at an alarming rate. Assets in the fund ballooned from just $34 million at the start of 2009 to more than $21 billion by 2014. That sounds a little bit familiar to me. Just like many of these other examples, all that money poured in just in time for the fund to underperform the market. From 2014 to 2016, that fund underperformed the market by 25%, and assets left the fund as quick as they rushed in. Now, I don't know if Cathy Wood is going to outperform the market in the upcoming 10 years or underperform the market like many other examples. Maybe she will be the Peter Lynch that has great annualized 30% returns for 12 years, or she'll be like one of the mini fund managers where her returns underperform the market after greatly outperforming it. This outperformance has been tremendous over the past year. Her fund has crushed the S&P 500. It's crushed basically every tech fund, and assets have piled into it. But my concern and my warning to people rushing into Cathy Wood's Ark Invest now is that your biases that may lead to underperformance still exist. They exist whether you're investing in Cathy Wood's Ark Invest, whether you're investing in the S&P 500, or whether you're just buying individual companies. The urge compelling you, tempting you to buy in after the returns have been remarkable, are the same urges that are going to tempt you to sell when things reverse. If this fund ever has a downturn, a significant downturn, and it starts to underperform other indexes or other categories, investors will want to sell. That's what will happen. That is human behavior, and you have to know that going in.
Most people have stocks in their investment portfolio, and for a good reason. According to Ibbotson Associates, stocks have reliably returned an average rate of 10% annually since 1926. Joseph Carlson believes in this premise. He has a dividend portfolio that is so diversified that he manages to be volatility-proof. You must weigh the potential reward against the risk to decide if it's worth putting your money on the line. Understanding the relationship between risk and reward is a crucial piece in building your investment philosophy.